Alright guys, welcome to today's video, which is about order blocks, also known as POIs or supply and demand zones. So, what is an order block? Well, order blocks are where buy or sell orders are resting, right? These are also where big banks put their orders, which we as traders use to our advantage. Now, where would these order blocks be? Well, we can draw them out, right? So, order blocks usually rest where liquidities are, right? Because that's where monies are placed and stop losses are placed. So if we were to take a look at this, an order block would typically be around these points, right? This is where liquidity rests, right? Liquidity rests, and these are also where order blocks are made. So these are examples of bullish order blocks, and bearish order blocks will look something like this at these highs, right? And you can see that in my drawing, you can see that as price went up and came down, it came to this order block. The orders in here that were previously made here were filled and price went up in the current direction, right? Now, how do we see this on the chart? Well, let's take a look at a few examples on the chart. So, let's take a look here. If you remember from last video, we have our range swing high and swing low, right? And these are our liquidities, right? And so as we can see, this is how we would draw an order block on our charts, right? Take a look. An order block is we would draw it from the candle before the big move up, this big move up here, right? So we look at this 15-minute, we would see that this would be our indication of a move up, right? Because I can see here, price stays in the same area. So how would we draw an order block? Well, typically, an order block is paired with a fair value gap, which makes it more effective, right? So we see our fair value gap is right here, right? From wick to wick, we have a little space, right? This would be our fair value gap. Our order block tends to be, or should be, connected to the fair value gap in order for it to be effective, right? So as we see here, we would draw our order block from here of the previous candle before the big move up, the wick of the high and the low. So in this case, if it's a bullish order block, we would take it at the high of the wick and draw down to the low of the order block, or in this case, it would be this candle that created the low, which also, we know, created liquidity, right? This gives us confluence that we currently have order block paired with a fair value gap, which makes it very effective. And this, I call this a POI, point of interest. However, they all mean the same thing. So if we were to continue to draw this POI or order block forward, we can see that price made its moves, right, in the market, came down to where orders were filled back over here, right? Orders that were resting, such as buy limits and their stop loss below. The bank's orders and traders' orders were filled, and price rallied higher, right? Now, let's take a look at another example. Right here is a great example, right here. This order block is only consisted of one candle, because this was the candle that indicated the move below down, and as we can see, it is paired with a fair value gap, right here. So how we draw it, we take it from the wick of the top wick, since it's bearish, all the way to the bottom of the wick that's connected to the fair value gap, right? And this would be our POI. And notice how liquidity is right. Buy side liquidity rests right above, right? So if we were to take a look, we would see that price came up right here to the tick, and orders were filled, and price rallied down. Now, this would be called a demand zone, supply zone, and a demand zone, right? Now, let's take a look at a POI or an order block, right? So we see here that this, if we were to draw it out in lines, looks like this, right? Now, this would be an order block, however, it wouldn't be as effective as it's not in the swing higher, swing low, right? With this big move. However, sometimes price can still react to it. However, in this case, price, as you can see, ran straight through with these three candles, right? This candle, right, closed below this wick right here, right? So you might ask yourself, okay, what does this mean, right? So when an order block or a POI gets disrespected, we call this what's known as a breaker block, right? Because it broke through the order block, a breaker block. So what does this mean? This is the same concept as an inverse fair value gap. When instead, this is an inverse order block, which means that, as you can see here, the candle right after it got disrespected came up to this order block and went lower. You might ask why? That's because all these buy orders that were just in here just got disrespected and got stopped out. So now we are looking to sell, right? Same concept as an inverse fair value gap. All right, let's take another example. Look, we can see, for example, right here. We'll see a fair value gap right here, and we see that liquidity rests right here, right? Which means that our order block would tend to be, let's change this to fair value. Our order block would tend to be from this candle right before the fair value gap all the way to the sell side liquidity. And if we were to draw it along, we can see that price tapped in and made a little move up. However, not always will it make a huge move up, as we can clearly see, because we're in a downtrend, bearish confluences are still being respected, right? So we got ran through. However, let's take a look at an order block if it doesn't have a fair value gap connected to it, right? So let's take a look. Let's take a look at this example. Okay, as we can clearly see right here, this is where sell side liquidity is resting, right? And inside here, you see that orders were filled, right? It doesn't do much. It just comes back and forth, and that makes a huge move up. However, we see where the resting is, that this would not be an order block, right? Because we do not see a big move up, and we do not see a fair value gap paired with it, right? So if we were to technically drag this order block over, we can see that price came in and it got disrespected. There was no huge move up like we did right here, right? This is why it needs to have a fair value gap connected to it in order to make it more efficient and effective. All right, we can take another look at an example. Let's say right here, right? We're currently at the top external liquidity, right? We see our buy side external liquidity, and we see that we have a fair value gap present, right? Now, what we would do is, because this is bearish, we draw from the low of the candle that created as connected to the fair value gap all the way to the liquidity, right? And if we were to drag it along, we would see that price just tapped in and then orders were filled. See how if it's connected to a fair value gap, it is much more effective, right? Like if you take a look at here, there's not really much except this fair value gap right here, right? However, if you take a look, we kind of have this weird candle here, right? Like if we were to take a look, if we were to take this fair value gap and then have this little POI and drag it over, price immediately disrespected it, right? That means that there must have been a more lower order block down here, right? So how do we pair this with all the other, let's say, confluence that we learned, right? Well, if we take a look at, we can take a look at this example here. If we take a look, this could also be an order block, right? This right here. You could take this as a trade, right? Because remember, order blocks are made at the lows and the highs. So in this example, there would have been an order block right here, right? So let's take a look. Okay, we see that we have a fair value gap, right? And we see that we have an order block connected to it from the candle that made the fair value gap and the internal sell buy side liquidity. And we can see that although this candle went of this wick came past it, it still closed inside, making this valid, right? So how would we enter off of it? We would see a big reaction, right? And we see that this technically created another order block, right? Another order block. Now we would wait for price to come back to the order block. And if we see a reaction, we can take a trade off it. So if we were to take just this trade, we'd be like, okay, we see price doing its thing, and we see price comes up and starts respecting it. Once you see this huge candle down, you can technically enter like this with your stop right above the order block, targeting sell side liquidity, right? Another example is you can target the fair value gap created with the POI. So you could enter off of a fair value gap with the stop above the order block, right? As you can see, you weren't stopped out, and we could target, let's say, these lows here, right? If you want, you could also keep it going all the way till the end, but in this case, it never reached the lows these, and you would have been at break even. That's why not all, although these confluences are paired together, it's not always 100% guaranteed on the trade, right? In trading, it's all about probability. Let's take a look at a trade that I took during markets at with paired with a breaker block, which is the inverse of a order block. So if we were to take a look here, we see that price is like this, right? Price goes down, and we see order blocks that are resting here and resting above here, right? But if you were to take a look, you'd be like, oh, well, we see that this fair value gap got disrespected. I mean, this bullish order block got disrespected, right? We see a fair value gap that got ran through, so it becomes an inverse fair value gap, and we see bullish order block that also got ran through, right? So this would become a breaker block. Remember, it's from the high to the low, and it has to be connected to a fair value gap, and it's wick to wick. So this was the trade I took and announced in the Discord, and I made the stop above this high with the breaker block and inverse fair value gap, and we targeted the lows over here, right? Now, why would this work, right? First, if we were to take everything, we would see that we get a break of structure, right? Then we see that because this break of structure was created, these fair value gaps and this bullish order block was disrespected, so they both become inverse. Not only do we have the inverse and the break block, we also have a regular bearish fair value gap, right? So now we have 4 confluences that are paired in one, and we see that price reacts off of it and heads lower. So what I want you guys to do is go on the chart, find the order blocks, right, or the point of interest, find ones that are connected to the fair value gap, see how price comes back to those points and reacts off of those, right? Also find order blocks that are at the external, and also find order blocks that are in the internals that get disrespected, and see how price comes up to them and reacts off. This would be the 4th concepts that you guys have learned, and if paired with around breaker structure, liquidity sweeps, fair value gaps, you guys can make a decent strategy with them, right? If we look here, let's look at one more example just to make sure that you guys understand that if we were to go on, let's say, this 15-minute, we see a tiny fair value gap here, right? Wick to wick. And then we see a nice order block from wick to wick. If you were to drag it along, price came up directly into this and sold off. Because these are where banks leave their orders, right, at these externals, and this is how they control the market, as we ICT must take advantage of that. Hope you learned.